Bloomberg Money.
Good noon, everyone. Bloomberg Money on personal finance, on retirement, on wealth management. I'm Tom Keene. With me today, Lisa Mateo. Scarlet Food deep on assignment, secret assignment for Bloomberg. Wonderful to have you here. The Knicks parade is over.
I do. I still have my orange and blue.
Yeah,
yes,
it's for my Jalen. I understand that as well. Wonderful to have you here. What are your thoughts? You mean you haven't even started saving for retirement? No. You're so young. But what are your thoughts on retirement as a concept?
It's a scary concept. Like,
it's scary.
Where do you put your AI exposure? And that's a lot we're going to get into.
It's a set of fears because there's a group that's nailed it. They all bought NVIDIA. Romaine Bostick, double leverage NVIDIA at the top. Everybody else is in last place like me. And you're right, it's scary.
It is definitely scary. I mean, the AI trade this week has been really tough. Chip makers, Intel, look at Intel, down 2.5%, more than that.
I missed that. It's good to know that as well. Let's do this. Tell you about the show today. Abby Joseph Cohen will join us in remembrance of Alan Greenspan. Abby Joseph Cohen also on what it takes with that fear Lisa Mateo was just talking about to participate in the market.
Yeah, and we have Dan Skelly as well, Morgan Stanley Wealth Management, where he sees opportunity. But just as we were talking about, that AI exposure, retirees, near retirees, how much, should they maybe reposition themselves?
And the big thing in his research note with Lisa was mental block. The Morgan Stanley note, the biggest thing, it's okay, David, on a Friday to have a mental block. It's all right, I just want to be sure. Romaine Bostick would never have a mental block, folks. I can tell you that right now. The best thing about it is Dan Skelly on Mag 7. And we'll get to that. Let's save the show with a data check here. We look at the equity markets right now. And you know what? The VIX was at 20, and we come in nicely on that with the VIX today. Dow up 160 points. Red and green on the screen. I'll leave it at that.
Yeah, S&P 500 up about 23 points, 7,381. Want to go to the 10-year, 4.37%, down about 1 basis point. But oil, Brent crude $71, but WTI crude $69 a barrel.
Very good. Romaine Bostick with us here, of course, as he gets ready to exit out June, if you will. We're almost done with the second quarter. And David Gura with us as well, getting ready, of course, for Bloomberg this week. And David, it's hidden now, and it's not in the zeitgeist, but I think it's an editorial in the Washington Post, which is in your wheelhouse. Elizabeth Warren is upset about Social Security, but the senator from Ohio is as well. How do you get a Republican and a Democrat on the same page on Social Security?
This has been a banner week for bipartisanship until the housing bill fell apart, but we saw kind of moves in that direction that we haven't seen in a long time. But Bernie Moreno, former car salesman, now senator from Ohio, and she coming together on this proposal to eliminate the cap on payroll taxes that go toward
raise the taxes on the rich people.
Raise taxes on the rich people. Look, this is a roiling conversation, not just between those two lawmakers, but a broader group of them. Some have suggested that could be raised higher. They're suggesting it could be eliminated here. But the argument that's advanced in that piece that you mentioned in the Washington Post by the editorial board is in doing this, you don't stand to cure the problem with Social Security. It's solvency long term, and it could have dramatic effects on the economy going forward. It could be a real hit to GDP.
Jack Lew with us yesterday with his expertise, last week with us, with his expertise on this. The thing I would note, David, is a pregnant paragraph that says if they do this, if you get a Warren Moreno bipartisan effort, the marginal tax in Ohio will be like Sweden. The marginal tax in the Commonwealth of Massachusetts will be like France.
Higher than any place in Europe, I think, was the line. So Senator Warren acknowledging that, but moving forward nonetheless.
Romaine, I want to turn to you. With your work on the close, paint the inflation picture for us, what it's been of this week, and then looking into next week with the jobs report.
Higher.
You got to do more than that.
It's high. I mean, and we talk about the headline numbers. I know the Fed, they love to strip things out, but as you know, I mean, Tom does not actually go to the grocery store. But for those of us who actually have to shop and fill our tank,
we see that he know that?
We can't strip this out.
I go to the liquor store. I don't go to the grocery store.
Exactly.
I've seen him in Gristini's wandering around endlessly. I don't know.
4% on the headline PCE numbers, above 4%, over 3% on that headline CPI number. Even the core, we're still talking elevated levels. And it gets to this idea of what's driving that. We can talk about oil and gas prices. Look, oil is down, as you were just pointing out. That's good. I'm going to fill up my tank for the first time in 3 months. Grocery prices are still high, but there's a lot of hidden inflation out there. One thing we talked about on the close, there was a 15% jump in basically what they call computer software and accessories. But here's the problem. That doesn't really get factored into CPI. It has basically a weighting of like a fraction of a percent. So that doesn't show up. But you're going to buy a new computer, aren't you?
On a weekly basis.
Okay, well, you're about to pay 20% more for
This
that.
is important. I'm so intimidated, Romains, here that we have to, as Andrew Marsh used to say, we have to produce the show. Let's listen to some of the Bloomberg voices on inflation.
Right now, the problem is inflation. 40% of the CPI basket is running above 3% right now. This is an American per people that is going to have to contend with ongoing inflationary pressures.
Supply-driven inflation, which could be oil from the U.S.-Iran conflict, that's an issue. But if we can fade some of the supply-driven shocks, which we are seeing in terms of oil prices and where they've plummeted, we can live with that.
The sharpest oil supply shock in history has somewhat ambiguous effects. We're learning that supply disruption risk is higher than widely believed.
This is probably the last bad headline inflation report we're going to have for a while.
The economy is going to strengthen. Inflation probably is going to slow down.
We're going to see peak rates and peak inflation in the second quarter of this year.
Inflation is still at way too high above the top of the range.
Great set of voices there, Romain. I look at this as a debate into July, and it really cuts both ways. I got people looking persistent 3%-ish, and Goldman Sachs this week really moving it down to a potential sub 3%, even towards 2%.
And this is going to be a big debate at the next Fed meeting at the end of the month. Because remember, we talk about sort of the outline that Kevin Warsh has for where he thinks inflation is going. But don't forget, you have Lisa Cook, Alberta Muslim, and all those people really talking about this idea that underneath that headline number, there's a feel out there that people have that does have a direct read-through into the economy.
Did you see the CFA pass rate?
I did see the CFA
level
pass
one,
rate.
level two.
I know.
It was like, it's coming back. I mean, they got through the pandemic.
They got through the pandemic. It's coming back. And, you know, the importance of that is coming back in terms of being able to really understand the fundamentals of our economy and our market. As you know, Tom.
Abby Joseph Cohen with us. That'll be great to see as well. One more, Lisa.
Yeah,
quick.
David, I want to bring it back to you. The war in Iran, oil, that vessel that was hit. How is that affecting traffic continuing to flow through the Strait of Hormuz?
Interestingly, it is continuing to flow, but I think we all kind of took a breath when that happened. The expectation is a lot of these ship-owning companies are very cautious about how they're maneuvering their ships through there, and we saw the UN agency that oversees maritime issues indicating that this can't stand. So this is still very much a roiling issue that I think policymakers around the world are facing, companies are facing too. And yes, oil prices are down. We're waiting on gas prices to come down even more substantially. But we should point out, yes, there was that initial meeting that took place in Switzerland, but very little progress, as we understand, has been made since, and that's really what we're waiting for, is some indication
This
of
has
that.
been a success. I didn't know they were in speaking terms.
Lisa and I? Yes.
It's amazing.
Only when the cameras are
Bloomberg
on.
this weekend.
Yes.
What do you got on Bloomberg this weekend?
Samantha Power, the former administrator of USAID, is on a long conversation,
Yeah.
and it's almost a year since that agency was closed. So we talked about the consequences of that as she sees them, the consequences of those cuts, especially as we see this Ebola outbreak really picking up steam in Africa.
David Gura, thank you. Romain, thank you so much.
Right, Tom.
Before the close this evening, coming up, without question, our conversation of the day, Abby Joseph Cohen, formerly with Goldman Sachs, with Columbia University. You're afraid, as Lisa mentioned, about the turmoil, the cacophony in the market. Abby Joseph Cohen, the courage to own equities. Thank you, guys. This is good. I did not know you were in speaking terms. This is great. Welcome back. Bloomberg Money. Lisa Mateo in for Scarlet Food today. I'm Tom Keene. Thrilled you're with us here on personal finance, on retirement, a different twist on wealth management as well. She is simply iconic. Abby Joseph Cohen was with Goldman Sachs for years, definitive on the equity markets, a piñata for the bears, beaten up on her constantly as the market went up and up. We'll show a great chart of that here in a moment. And then wandered to something more magical. Columbia Business School, teaching grizzled graduate students. Thrilled to have you here. What did you say to the graduate students this week about Alan Greenspan?
Well, first of all, Tom and Lisa, I'm delighted to be here with you today.
Thank you.
There's so much to say about Alan Greenspan, and so much has already been said. There were two personal episodes that I had with Alan, and both of them left me smiling when I thought about it. And let me discuss the first one, which is the more recent one. Not that long ago, just a handful of years ago, Alan published a book that he had co-written with Alan Woodridge from The Economist about capitalism in the United States. And it was so incredibly sharp. They asked me to moderate the panel. And the discussion with him at that point was right on topic. And to your point, one of his concerns had to do with budget deficits and also Social Security.
I look at Alan Woodridge's work with our editor-in-chief, John Micklethwaite, and it is that historical construct. The Greenspan critics will say he got wrong regulation. Did you perceive that while sitting at Goldman Sachs?
When I met with Alan and other members of the FOMC, I did talk about the regulatory aspect. And the thing that was interesting to me is that they were well aware of some of the problems that were developing in the housing market, for example, and in the subprime credit market. And that was his biggest concern. You know, the so-called irrational exuberance speech, which so many people think was about the stock market. I had met with him just a few days before. I think that speech was largely about fixed income markets. He was concerned, for example, about the inadequate risk premia in corporate bonds. He was also concerned about the inadequate risk premia in sovereign markets outside the United States, particularly for some of the smaller, newer countries that had not yet established themselves or established their credibility.
Can you explain why Greenspan, why he's key to understanding today's Fed?
Yeah, I think that his approach was an important one. First of all, very long dated. Right. He wasn't terribly interested in the short-term market moves, either in stocks or bonds, number one. And number two, he and the team spent a great deal of time looking at economic developments, what was happening, not month to month, but the underlying structure. And one of the conversations I remember most with Alan and the FOMC had to do with work that I had done in the early 1990s about the technological changes underway in the U.S. economy, what that meant in terms of providing problems, analyzing data, because we weren't collecting the data properly.
Lisa, it's like she knows our script. It's like she was in the planning meetings for Bloomberg Money. Let me do this, Abby. I got to bring this up, Abby. This is from her most famous paper on Aristotle, and it's the giant Peter Bernstein. It is one thing to set up a mathematical model that appears to explain everything. That sounds familiar. Our lives teem with numbers, but we sometimes forget that numbers are only tools. That's where we are right now, isn't it?
That's exactly where we are, and the training I received as a junior economist at the Fed helped set me up in terms of looking at things in that way. In addition, looking at the economy in the 1990s, recognizing that economic data were not picturing and not capturing what was happening in the newer, faster-growing segments of the economy. Same thing is happening right now. Very often we forget that GDP and so many of the other statistics are samples, right? We won't know for 3 years or 4 years what the real numbers were because we're working off of samples. And if those samples are based upon the companies and industries that used to be important rather than the ones that are important or will become important, we mislead ourselves in terms of what's going on.
Would you be able to dig into some of the dilemmas that are facing the current FOMC?
They have many.
Yes.
Many.
Where do I start?
That's right.
And this is going to take the rest of the program. Did we plan this?
I'll try to be brief.
Yes.
You know, we all know that.
That's a first. Please.
Give me another 2 hours.
FOMC.
You know, Kevin Warsh has announced setting up new task forces, and one of those has to do with data analysis and data quality. And I give him a hats off on that because it's really, truly needed. There are some fabulous people at the Fed who work on data all the time, and to recognize that they need some additional assistance in terms of identifying which are the data items, statistics that are really important. And if I can point out that we've not done a good job as a nation on this, the Bureau of Labor Statistics that we rely on so much has been underfunded, not just in this administration, but going back several years. So at a time when the economy has gotten more complicated, more tied into the global economy. We need more information, not less. We're getting less information.
I've got to squeeze this in here. We're going to come back with Abby Joseph Cohen, but this is definitive. It's the Ibbotson chart of Yale University. It was definitive, I'm going to say 30, 40 years ago. Roger Ibbotson, Abby Joseph Cohen helped codify this. This is a logarithm chart. Slope matters, as my friend Brian Sullivan used to tell me. The depression in the lower left corner, the Guadalcanal low of 1942, and up and away with the optimism of Abby Joseph Cohen. Do we still have the optimism of the Ibbotson chart?
I think we're at an important point of inflection now, Tom, because you mentioned the CFA program. I'm a CFA. I was chair of the board of the CFA Institute, so I believe in digging through the numbers and digging through valuation. Right now, the valuations basically say everything's fabulous. And when things are priced to perfection, that's when investors need to be concerned and careful.
I mean, I look at this, Abby, and we have to be quick here, and I want to come back with you. But the fear that's out there now is an original fear. Is this time different, to borrow from Rogoff?
There are always differences, but there are some things that are standard and basic, including corporate profitability, corporate balance sheets, and the underlying strength of an economy, which is measured not just in GDP and industrial production, but also job creation. And we are not creating sufficient jobs right now.
I've heard that from Nancy Lazar as well. It's structural disruptions in the global economy. That's what she teaches at the Columbia Business School. We're going to come back with Abby Joseph Cohen, Lisa Mateo and Tom Keene with us. We're also going to hear from Neil Kashkari of the Minnesota Bank. This is from New York City, Bloomberg Money. Good noon, all. Welcome back to Bloomberg Money. Tom Keene with Lisa Mateo, Scarlett Fu on assignment, pulling a short straw. Geez, I'd like to spend the weekend in Aspen. That would be Lisa Abramowitz, smarter than either Mateo or Keene. She spoke with Neil Kashkari at the Aspen Ideas Conference.
Workers ultimately are going to demand that they be able to make their basic ends meet, that their needs be met. And so one of the challenges is, even if these supply dynamics fade, I would expect wages to continue then climbing to enable workers to slowly catch up.
The gentleman from the Minnesota Fed, and I would say there, with this huge call on inflation, will there be an actual wage growth adjusted after inflation? We'll have to see on that. Lisa?
Yeah, let's bring in back Abby Joseph Cohen, Columbia Business School. Everyone knows you from Goldman Sachs as well, your time there. I want to start with personal finance. You have, graduate students, MBA students. I actually did a story where it was about the high school students and how the rules are changing. Come the fall, they're going to be mandated to take personal finance or have some kind of exposure for it in order to graduate. Do you think this is a good thing, getting them started younger and younger into the personal finance?
I think it's a fabulous idea, because one thing we do know, it's not just the young people, it's also people in middle age who don't know enough about personal finance, so the sooner the better. The other thing that's happening in the city of New York revolves around the Cornell Tech campus, which is on Roosevelt Island, where there is now a program on entrepreneurship for high school students. Clearly, growth in this city and growth throughout the economy will depend upon knowledge of personal finance, knowledge and interest in entrepreneurship, and I think that educational institutions are getting their act together on
So,
this.
Abby, what's so important here, to Lisa's great question, I think of Rebecca Patterson providing real leadership on this to kids in education, is we're getting more knowledgeable about innovation on an island of Cornell. We're getting more knowledgeable at Columbia about personal finance, et cetera, and yet we've got a politics in our cities, including New York City, that doesn't like capitalism. I'm not sure they like innovation. What are your thoughts on the swing that we see of a large body of our public? They say capitalism has failed.
I think many people are responding to the idea that there has been sluggish job growth, there has been sluggish wage growth, and people are feeling stressed. And when there is stress, be it either on the right or the left, there is a worry and a concern about what to do next. I hope that business leaders and political leaders will come together and recognize the focus has to be on growing the economy rather than just rearranging the slice of the pie, although with regard to the slice of the pie, clearly we are seeing a very significant distortion, something very dramatic over the last 10 to 15 years.
Can I do an audible, Lisa?
Of course.
There's a job opening, Abby. I don't know if you're aware, the New York Mets fired their manager. I can see you slotting in there with Mr. Cohen.
Well, I am a Queens girl. And a Mets fan. However, I am not sure that I'm the right person. I like to stick with things that I really know a lot about.
Well, okay, we'll try that, but we'll see if the dreaded Mets can do better, certainly doing better than the Red Sox. Abby Joseph Cohen with us today. Thank you so much for joining us forever with Goldman Sachs and her Columbia University. Lisa?
All right, we have Dan Skelly. He's coming up. He was with Morgan Stanley Wealth Management. He's going to be talking a lot about personal finance, but also retirement. That's a big question. How should you change things up as you're looking to get to that stage, or maybe you're near retiring stage? What should you be looking for? Dan Skelly joining us next on Bloomberg Money.
I look at where we are. Red Sox fired their manager, Mets fired their manager. It's a new trend that's going on.
It's a new day.
The Knicks did not fire their
The Knicks, no, he has tenure. The Knicks manager has tenure.
At least for the time being. Thank you both very much.
Welcome back to Bloomberg Money. Tom Keene, Lisa Mateo, and for Scarlet Fu. That's a good and wonderful thing. And of course, Lisa Mateo this weekend. Bloomberg this weekend. You'll see it Saturday and Sunday starting at 7. Is it a.m. or p.m.?
7 a.m.
7 a.m. as well.
There's no way in p.m.
Let's do a data check and save the moment, Lisa.
Let's get right to it. So the tech trade kind of facing a number of headwinds, but not much movement right now. S&P 500, 7,361. The Dow down about 23 points. The NASDAQ up about 6.
Lisa Shallett called up. She said, if you don't do a cross-asset data check, Dan Skelly can't come on. There it is, equities up. Dollar is a really twisted event this week. It's been a stronger dollar, making your personal finance trip to Europe a little bit better. Crude oil, a story of its own, down 3.95%. Lisa?
All right, Tom, I want to talk about something you talk about, which is about the teens on their laptops doing the investing. Gen Z, yes, they are going all in on investing. But there's a lot of things, right? There's a line between investing and gambling starting to get blurred. We have social media playing this bigger role. So let's dig into it. We have Bloomberg's Justina Lee joining us. Justina, thank you for joining us. Want to start out with everything. We have prediction markets, right? We have the legality of sports trading. You have social media, right? You have, Kalshi teaming up with some of these college students talking about this. Where does the downfall in Gen Z, how much involvement is this, and what are the ramifications of it?
Yeah, I mean, for my recent story, I spoke to some of them, and a lot of them have told me that, we tend to think that people just love gambling, right? But they've been kind of talking about how they feel like with the affordability crisis and generally this sense that you can't really just kind of reach the American dream these days with just, one regular income. And so they kind of feel like they need to take big risks. And I think that might also be fueling a lot of the phenomena that you just talked about, right? With like the rise of prediction markets and people trading options and people kind of betting on sports more. And it's kind of interesting that it kind of all fits into this broader socioeconomic picture that we're seeing.
And that's what I want to touch upon, too, this broader picture. I mean, I have a son, 24, so in this stage, they're frustrated, right? Some can't find a job. Some are worried about AI. They're worried about if they can ever get a home. So is it more the economy than these other things we've been talking about?
Right, exactly. And there's this term that, one podcaster coined, which is financial nihilism. And it's this idea that kind of if you feel like you can't reach your goals the regular way, you actually start kind of feeling more risk hungry because you feel like I don't have that much to lose anyway. And so I might as well take these bigger risks. And that actually kind of fits into the broader literature about like kind of behavioral economics. And for instance, like one other phenomenon is that people tend to overestimate kind of like low probabilities. And we kind of see that in, sports betting, for example, where a lot of people love these long shot bets or they love parlays. They love piling on bet on bet on bet. And, they don't have a very high chance of paying off. But when you look at the payoff that could be possible, that can look very attractive.
Oh, Justina, I hear about those parlays. We appreciate your time. I know, Tom. I know.
Paul Sweeney and I, we just shake our heads and go, you got to be kidding me. And yet there it is.
It's a thing.
It's a thing, and I'm still not used to it. Thank you so much for that, Justina. Bloomberg Money, and that means we need to go out and read 30-page reports. You can do that with Daniel Skelly and Lisa Shallett at Morgan Stanley. Skelly holds down the fort, head of equity model portfolio at work there, and it'll be a 20, 30, 40-page paper. Guess what? It's as simple as this. There's always one paragraph. The paradox of a placid market amid semi-euphoria. We think next year, 07 into 28, I can't believe that, with a return on the big seven, well, it could be a phenomenon with AI, capital spending slows, and all of a sudden, free cash flow. Dan Skelly joins us from Morgan Stanley. That paragraph stopped me cold. Am I supposed to buy Mag 7 this afternoon?
Well, they're certainly cheaper than they were 3 weeks ago, and it's great to be back with you, Tom, and congratulations on the new program.
Thank you.
So the big cloud overhanging the Mag 7 for 9 months now has been excessive spending, and we've seen a lot of growth equity and capital flow into semis. They've had parabolic moves. We think today, if we were to draw a historical reference, looks a lot like the first half of 1995. Where semis also came out strong out of the gate, but eventually peaked, took a 50% drawdown, and did nothing for a year. But chronologically, we were in 96, 97, with 4 years left to go in the cycle. We think that's kind of what this cycle looks like.
The heart of this, and your enthusiasm here for a redo of Mag 7, is when do you acquire new shares? It's a phrase from John Templeton as well. Within wealth management, if you've got cash now, do you deploy it here, or are you waiting for a famous Lisa Shallett signal?
We would be deploying today, and we think, frankly, a lot of folks have legacy positions in the Mag 7, which, as we all know, is truly just FANG plus or minus 3 or 4 stocks. So these stocks have...
Yeah, this is the heart of the matter, Lisa, is within wealth management, with, what Dan Skelly's doing. Everybody owns this stuff. OMG, a correction. Now what is the major message into the second half?
Yeah, and you're talking about Mag 7, so AI exposure. I mean, you're talking about retirees, near retirees.
Sure.
Should they change things up? I mean, should you move away and make it more diverse?
Absolutely, and Mag 7 is but one part of a multi-pronged strategy. Within equities, we'd also be adding to some value ideas here that have lagged, i.e. financials and healthcare, which, by the way, should be some of the best AI adopters over time. We've only rewarded AI CapEx so far, but what about the adopters? That's a longer-term play. And then we're also advocating outside the U.S. in terms of equity positions. But more broadly, from an asset allocation standpoint, we've talked about hedging equity risk with real assets. That's been an okay play this year, as well as long-short hedge funds that have exploited the volatility.
I'm curious about your take on alternative assets in 401k plans.
It's a very thorny issue. I think ultimately it's gonna be implemented over time once we figure out all the rules and rails. But at the moment, there's, I think, a growing realization that alternatives are going to help diversify a legacy 60-40 playbook, which with very high correlations between fixed income and equities that may not be as relevant today.
I mean, Dan, you don't know this, but at Bloomberg, they have the Tom Keene rude moment of the week. My rude moment of the week was with Gary Gensler, the former chairman of the SEC. And being a wise ass, I said to the good Gary Gensler, I said, hey, Gary, what about those persons bought Bitcoin at 110? 110 down to where are we, Lisa? 59, 58,000 as well. How do you and Morgan Stanley handle losses in retail Bitcoin?
Tom, I could never imagine that snarky comment from you ever. That's so out of character.
It's like a first.
Kudos to my teammate, Denny Galindo, who's really led the research thought leadership around crypto and digital for some time. And as he's outlined on this channel before, he's outlined this 4 seasons of crypto. And we've been talking about being in a crypto winter at the moment. Eventually that will thaw, and we think going into next year, as we get closer to the next halving, we'll have a better crypto tape.
Let's go to first principles on retirement. We're living longer.
Yes.
Does that mean I need equities longer? Is it just that simple?
You need to stay in the market, absolutely, but you also need to think about the mix of equities. You need to think about hedging some of those concentrated legacy bets, and we can do that with sophisticated tax plans. How do you hedge
somebody who got lucky with Apple?
There might be option strategies around that and specific tax strategies, and we are definitely leading the charge on that front. But the other thing to mention as well is thinking about cash flow. right? A lot of these folks had, once upon a time, relied on traditional fixed income. We think dividend growers, in particular, is another source of rising cash flow that makes sense for retirees.
I want to talk about the markets quickly.
Sure.
Seeing the reaction from geopolitical, issues that we've been faced with. What does it look like going into midterm, elections? How do you think things are going to be different?
It's such a great question. And look, over the last year, the markets and the economy have looked through policy shocks, be it domestic in nature, whether it was Liberation Day or whether it was Iran and the Middle East most recently. We've been saying the market's been treating policy shocks as pop-up ads. And it's been along the way of this longer winding main story around AI and a resilient consumer. Let's be intellectually honest. We do think the next pop-up ad is the midterms. And so we think it probably does cap some of the upside that we've benefited from with this 20% move off the March 30 low. And, look, at the end of the day, as we always do amid these political cycles, we'll get through it and we'll start thinking about opportunities into 27.
I love the pop-up ad reference. I want to quickly mention the Fed with Kevin Warsh.
Sure.
What are you excited about? What are you concerned about?
Another excellent question. And look, when you talk to Alan Zettner and some
Hold on. She said two excellent questions. I've had none. It's 2-0. Continue, Mr. Skelly.
You're still on our list. You're still on our radar. So when you talk to Alan Zettner and some of our friends in institutional research, Matt Hornback and others, friends of the show, look, we had all, like the street, been expecting cuts this year. We've been priced out of that. I think what we're most excited about is, in terms of the task forces, how does he really restructure the nature of the Fed and the communications longer term? And secondly, he did obviously advocate for a bit more hawkish front on short rates and getting back to 2%. But we all know he also wants to reduce the size of the balance sheet. So ultimately, we actually interpret that as somewhat of a wash in terms of a little bit more dovishness on one end and a little bit more hawkish on the other end.
Skelly, on rebalancing, what's the formula for rebalancing at Morgan Stanley?
So it's an excellent point, to be fair. And I would say it's one people don't think about enough, because at the end of the day, a lot of these positions in a concentrated manner have drifted. And so, look, what we advocate, Tom, is to be in touch with your advisor on a quarterly, yearly, whatever works basis, and think about your original plan vis-a-vis the effective weightings. And today, like I said, I think in particular, whether it be financials, Mag 7, some of the international themes, Japan that we like, these are things that have drifted lower in recent months and we would be rebalancing higher into.
I mean, this is really cool, folks. What you just heard there is gospel for me, that you don't have a rigid formula on rebalancing. I think that, I'm not going to mince words, I think that's a death here. So without original formula, right now somebody's saying I was rocking it on Mag 7 and now I can't retire next quarter, next month, next year. It's about patience, isn't it? I mean, you're rocking it and things are great, and then all of a sudden you get a June or a May here, and then you got to have the courage to stay with it. That's where we are right now.
Absolutely, and memory prices are through the roof, as we all know. And when you have major companies who have the utmost negotiating leverage, like an Apple, talking about no longer being able to hold the line on pricing, everything works until it doesn't. And so our point is, not only does the Mag 7 look attractive as this spending and CapEx cycle ultimately plateaus, as they all do in internet, in shale, et cetera, it's not a negative signal overall. Ironically, it's the most positive signal for the rest of the market, because the market, 80% of the S&P attribution this year is in semis, IT hardware, and power. It hasn't even looked at the adoption wave of AI, and that's what we're really positive on the coming years.
And you mentioned the market. So one of the things in your notes you pointed out is you called it the economy amid a remarkable stock market backdrop, but you called it an unremarkable economy.
Yes.
So what do you mean by that?
So this is one of our nuances in our framing, and look, what we would say, and Tom will maybe get a kick out of this, but drawing on some of our favorite SAT words, this is a classic juxtaposition between a unremarkable economic environment amid a remarkable rally in AI CapEx winners. Why is it an unremarkable economy? Two reasons. One is, as I just mentioned, we would, I think, intuitively perceive policy shocks to have more lasting effect. They're not, number one. And number two, going back on a comment I made 3 years ago coming out of that 22 hiking cycle, I think the consensus is realizing more and more that this economy has shifted, paradigm shifted away from more inflation and rate sensitive vectors towards more inelastic type economy. goods to services, high-income people spending on those services, and AI spending. All three of those dynamics are seemingly going on in perpetuity, despite month-to-month fluctuations in Fed expectations or oil prices. And that's unremarkable in the sense that it's no longer out of consensus. The consensus has come to agree or understand something we were talking about 3 years ago.
You got to come back. We got another half hour here at least. Dan Skelly, thank you so much.
Thank you.
With Morgan Stanley here, and I just can't say enough about that paragraph looking out 18 months on Mag 7. We did books a while back on Elon Musk, had a huge response to 3 books interested of Elon Musk. Now on Alan Greenspan, what are the books that we should consider? What books should Chair Kevin Warsh consider? Stay with us, Bloomberg Money. Thank you, this is absolutely wonderful. Love the Mag 7.
The other point is not only is the spending this slow, it's the capital.
Right.
That new space, autonomous, quantum, and robotics.
Yeah.
And so we're all excited about it.
Bloomberg Money, good noon, everyone, I should say. Still saying good morning. I gotta get used to that. Good noon. Scarlett Fu, deep on assignment for Bloomberg Money. With me today, Lisa Mateo.
Yeah, you got it. Bloomberg Money is your new destination for personal finance. Cross-platform effort that extends beyond your television, including our new digital hub at Bloomberg.com/money. Got to check it out, Tom.
Books on Alan Greenspan. How about a nasty little thin book from the gentleman of Washington University of St. Louis? Governor Lawrence Meyer wrote a very terse book on Alan Greenspan, A Term at the Fed. It's a must-read for anybody with an interest in American economics. Short, terse, tight. I love that book about the machinery of the Greenspan Fed. Everyone knows Sebastian Mallaby's excellence, doing so many good things right now, particularly at the Council on Foreign Relations. The man who knew, well, just simply, it is the definitive book on the chairman. And then 13 Bankers. This is a sleeper. This is an important book by the laureates Simon Johnson and James Kwok. 13 Bankers is on the crisis. And near the back of the book, Alan Greenspan shows up to consider regulation gone wrong. Those are 3 different books, I think.
So they each relate differently to different times in his life.
Different times in their life and different parts of the Greenspan legacy. It's not just, here's a big, thick book to read, although the Mallaby book is just elegiac. It's the one, everyone says that's the one to read.
Now, I don't want to put you on the spot, but I'm going to. Greenspan played a big role in your life, big influence, huge influence. We have a picture here of you with Greenspan. There we go. How much?
A few years ago.
You're looking good, Tom Keene. But talk about the impact that he did have on your life.
He was great. I don't want to get into it too far, but it was really quite a personal relationship. He single-handedly changed my life. There's no other way to put that. But he was great. And I think what we really hit it off was he was a legit clarinet player. He was not like pretend, like weekend warrior. He was the real deal before he discovered economics as well.
I love it. Let's turn to someone who can talk more about this. We want to bring in Bloomberg columnist Jonathan Levin. He has a great article out now. Jonathan, I want to ask you about Alan Greenspan. He was known for kind of fine-tuning the economy during the tech changes. So when we look at Kevin Warsh, can he go about those same? Can he follow the same playbook?
Yeah, the point of my column on Greenspan is like, look, it's obviously very tempting to draw parallels between AI and the internet era. And of course, Greenspan's famous call in the late 90s was letting the economy sort of run because he thought, incipient productivity was so strong, we didn't have to worry too much about inflation. My argument is that beyond those ostensible similarities, there are a lot of differences. So, take for instance the fact that Greenspan had demographics on his side, the Great Moderation. He enjoyed a long period of relatively low and stable energy prices. Obviously, that's not at all similar to the world we're living in today. And he was also following in the footsteps of the GOAT. He comes after Paul Volcker, and the trajectory for inflation expectations is improving big time when he gets in there. So,
Jonathan, thank you so much for mentioning that. The idea of Volcker to Greenspan is underplayed. To me, Jonathan, in your wonderful column, the distinction here is Greenspan gets a victory lap on his productivity, all done in hindsight. Is Chairman Warsh, is he going to get a victory lap on productivity?
I mean, I think the risk here is that it's too much of a gamble. It's too much of a gamble, Tom. And the reason being is that we have a lot of signs, as I was saying, that like the other factors are not particularly benign here. The energy market does not seem to be behaving itself. It's behaving itself this week, but who knows what the rest of Warsh's tenure is going to bring. And meanwhile, again, the trajectory is not good. This is not a world in which Paul Volcker has just crushed inflation and we feel like we've finally gotten inflation expectations under control. On the contrary, this is a world in which we thought we had inflation expectations under control, and we are just now coming off of five years in which I don't think we've lost the anchor, but it seems like we're moving in the wrong direction.
Jonathan Levin, thank you so much with Bloomberg Opinion.
All right, well, coming up next, we have a lot on what lies ahead. Of course, we have the jobs report next week, but also a lot of events. Of course, we look ahead to 4th of July, too, so a lot to tell you about. We'll look ahead and see what's in store for what your money is coming up this weekend. Also, a reminder, catch our newsletter. It covers a world of books on books. We give you the look ahead. This is Bloomberg Money.
Bloomberg Money on a Friday before we dash into, well, sort of a kind of like week. And then the 4th of July week, it's like a 2-day work week, which is normally what Lisa Mateo works. Let's do a look ahead.
Let's do it. So, so next Friday, of course, no, the bond market is closed. The stock market is closed. The bond market actually closes Thursday at 2 p.m.
The jobs report is Thursday. I just learned that.
Yes, because we're closed Friday.
I'm learning. It's
we're getting there. We're getting there. So it's Thursday. So the change in non-farm payrolls for June. Want to hit a few numbers? 115,000. The prior was 172,000. The change in private payrolls, 125,000. The prior, 120,000. But the employment rate for June, 4.3%, same as the prior. And we get to average hourly earnings month over month, 0.3%, same as the prior. Year over year, 3.5%. The prior was a tick lower.
And the look ahead here, looking into 2028, is we were earlier in the show, is the job economy hasn't cracked yet. Everybody's been waiting for it to fall apart.
They have, and we'll see what happens next week. And so keep in mind, write on your calendar for Thursday.
So what is Bloomberg This Weekend doing on a 4th of July extravaganza?
We are going to the Intrepid. That's what we're doing. No, it's a great because you have the parade of ships coming down, right? So you have that. So we'll be talking about that and have a lot of people come to the Intrepid to talk to us about it. But just in D.C. itself, there's so much going on, Tom. You have the 250th birthday. So that's why you have the National Independence Day Parade. You have on Constitution Avenue. There's a lot more. There's a concert on the West Lawn of the U.S. Capitol, massive fireworks display like we will also have here in New York. But we're excited to be out there on the Intrepid.
We'll have to see it. Bloomberg, and this weekend, you've got the important interview, David Gura, with on AID,
Correct.
and the collapse of that program. What else are you looking at this week?
I actually did an interesting study. I went to Brooklyn Preparatory High School, and I spoke with students there because come next year, they have different changes. It is mandated that they take or have some kind of exposure to personal finance.
You mentioned this with Abby Joseph Cohen.
Yes. So it's an interesting perspective to see them, and they just had their last day of school today, so we'll see how it goes into the fall.
Was this fun? Would you want to do this again?
It was.
Okay, we'll have to see if we could do this again. Scarlett Fu and I will be here every Friday for you, Bloomberg Money, to talk to you about personal finance, retirement, wealth management. Thrilled with the response, I should say, that we're hearing from global Wall Street to Bloomberg Money. Bloomberg This Weekend, look for that 7 a.m. on Saturday and Sunday. The trio will bring you forward into America at 2:50. What can we say? Thank you to our guests for wonderful conversation. Dan Skelly of Morgan Stanley, and Abby Joseph Cohen of Columbia University. Good noon. I think that this was very, very good. Scarlet, who?
Good.